Are you in the market for a new home or considering refinancing? If so, it's important to understand the relationship between the bond market and mortgage interest rates. Mortgage rates quite literally come from the bond market. In this video, I'll explain that relationship, and I'm also going to share the variables that affect the bond market. This will help you predict how the market will react to financial news or any headline you see. And all this stuff is really interesting in and of itself if you find stuff like this interesting, but I also want to bring this back around to something really practical. The bond market can be volatile and unpredictable, and you really need to know how to protect yourself from this volatility. As we get started, please take a moment to like and subscribe to my channel, and if you're in the market for a home, maybe you just found your lender. I'm here anytime you want to talk or have questions. So let's get this party started, if you can call it a party. First, I want to talk about how the bond market drives rates. The modern mortgage process goes something like this. It really starts with you. You find a house that you want to buy, and you work with your lender to set up a mortgage. And at closing, your lender makes a swap with you. You get money to buy your house, and in return, your lender gets a piece of paper. At closing, you're going to sign a bunch of documents, but the one that's arguably the most important, the one that really kind of is the loan, is called a promissory note. That's your promise to pay the amount you borrowed at a certain interest rate over a certain period of time. And this transaction is called the primary transaction, the money going from your lender to you at closing of your home purchase. Now, no lender has a limitless supply of money to lend to you. And way back in the day, this was actually kind of a problem. If you wanted to buy your neighbor's house and you went down to your local savings and loan and applied for a loan, if they didn't happen to have enough money on deposit to lend, they may have told you to come back later, maybe after the local farmers sold their crops and deposited enough in the bank to make the loan. And this idea is kind of homespun and charming, and it may be making you think of Jimmy Stewart in It's a Wonderful Life. But it is a super inefficient way to be sure that whenever people want to buy a house, they can do so. So back in the 1930s, during the Great Depression, kind of the OG housing crisis, Congress chartered Fannie Mae. And this created a secondary market for mortgages, a place where lenders could sell mortgages and replenish their funds to be able to lend again. So lenders can make a bunch of mortgages this month, next month, bundle them all up, bundle up all those promissory notes, and sell them to Fannie Mae, which gives lenders kind of a bottomless source of loan funds. They'll never run out of money because they can always sell promissory notes for the loans they funded to Fannie Mae and get their money back. But of course, Fannie Mae has to get its money somewhere, and that somewhere is the bond market. So mortgage funds come really directly and literally from the bond market. So what is the bond market? Well, a bond is just a type of debt. If you're a government, a business, or other entity, and you want to raise some cash, you can issue bonds. And the bond market is basically just a big swap meet where you can take your bonds and look for investors to buy them. When an investor buys a bond, they hand over their cash in exchange for a stream of interest payments. And what Fannie Mae issues, when Fannie Mae issues bonds, they're called mortgage-backed securities, often abbreviated to MBS. And these bonds are bundles of mortgages with similar characteristics. The process of bundling up and selling the bonds is called securitization. And before I go on, I want to add that there are some exceptions to this process that I just described. There are still some old school savings and loans out there, and credit unions and other portfolio lenders that lend their own money and don't securitize. And I actually work with quite a few of these, and they could be a great option if there's something about your financial situation, something about your income or credit or whatever that doesn't quite fit inside the Fannie Mae box, the lending guidelines Fannie Mae lays out. But when you color outside the lines like this, you always pay a little bit of a premium, and portfolio lending is really a small fraction of the mortgage marketplace out there. So ideally, we want to keep you inside the mainstream Fannie Mae securitized type of lending. It's also worth noting that Fannie Mae has a sibling entity called Freddie Mac that functions just the same way Fannie Mae does, founded in 1970 and also chartered by Congress. And FHA, VA, and USDA loans, the loans that are insured or backed by the government, are securitized by an entity called Ginnie Mae. So I want to take a little deeper dive into the bond market next, and we're going to start with a brain teaser. Investors pay a price to buy a bond, and what they get in return is a yield, and the yield corresponds to interest rates, the interest rate that's being paid by whoever is paying into that bond. And there's an inverse relationship between prices and yields. And this can be a little bit mind-bendy, but there is a logic to it. When the bond market is strong and lots of investors are competing to buy bonds, they're interested in buying bonds and buying lots of them, then bond prices rise. And I think it's easiest to think about this because we're more used to thinking about the stock market. Think about it like stock prices. Stock prices rise when people are buying stocks. And then due to the high demand for their wares, when bond sellers are selling into a strong market, they can offer lower yields, which is to say they can pay lower interest rates on the money that they're borrowing because there's lots of competition to buy those bonds. But when the bond market is weak and investors lose interest in buying bonds, and maybe they're even selling bonds they already own, then bonds fall in value, just like stocks fall in value when people sell stocks. And in a market like that, to lure an investor to buy your bond, a prospective borrower, a bond issuer, has to offer higher interest rates to attract attention and get someone to buy that bond. So interest rates fall when investors buy bonds, and interest rates rise when investors sell bonds. And of course, like any marketplace, supply and demand is also going to play a role and factor in as well. And the factors that drive the bond market are many and varied, but I find it useful to categorize them into kind of four broad categories. One is economic factors, also appetite for risk, also government actions, and finally inflation. And when we talk about each of these, which I'm going to do here, you'll notice a general theme that good news is often bad news and bad news is often good news. What you would normally think of as a happy headline is oftentimes bad news when it comes to the direction interest rates are going. And something that sounds like terrible news can often be really good news and push interest rates down. And after nearly 3 decades in lending, I'm kind of getting to a place where I don't feel quite as queasy about this as I used to. It's not to say I'm ever going to celebrate bad news, of course. I guess I've rationalized it as just saying that I'm really good at finding silver linings in otherwise dark clouds. Now, when it comes to economic factors, this bad news is good news dynamic is very much in play. Is the economy going great? Is job growth strong? Is unemployment low? Investors in an economy that's growing and booming and doing well probably don't want to own boring old low-yielding bonds. They want a piece of that dynamic, fast-growing, booming economy. So they're going to put their money into stocks instead of bonds. But when unemployment rises or there's talk of recession, a faltering economy can send investors looking for the safer, slow but steady returns that the bond market offers. Now, investors' perception of an appetite for risk is a factor in the market as well. The process of securitization actually makes mortgage-backed securities inherently less risky than a lot of other investments might be. There could be 1,000 or more loans included in a single mortgage-backed security. And maybe a few of those borrowers are going to default or pay their loan off early, which is going to cut into the interest that an investor is going to earn, kind of reduce the yield on that bond. But this isn't going to be a disaster because the losses are diluted by the majority of borrowers in that bond who are paying and paying on time. And standardizing underwriting guidelines also reduces risk. And I want you to remember this when we lenders start asking you for a bunch of paperwork, You apply for a loan and we start pestering you for things that feel random or silly. This annoying paperwork is part of this process of standardization that minimizes risk and makes mortgages a more attractive, consistent, predictable, and safe investment. So when scary things happen in the world, like a war or an act of terrorism or a bank failure, something that makes investors lose confidence, this can trigger what is often called a flight to safety. Investors rush to bonds as a safe, stable investment in an otherwise stormy sea. Now, government actions and monetary policy can have a huge impact on the bond market. For one thing, the US government issues a lot of bonds. When the government spends more than it's bringing in revenue, it has to cover the deficit spending by selling treasury bonds. And these bonds compete in the marketplace for investors' attention. When there's a higher supply of bonds for sale, then higher interest rates, higher yields are what can attract investors to buy some bonds. And that higher supply can drive prices down and interest rates up. But on the opposite side of the spectrum, sometimes the government steps into the bond market as a buyer. When the Federal Reserve buys bonds, it's called quantitative easing, or QE, and they create added demand. You can almost call it artificial demand, which puts downward pressure on interest rates. And then there's inflation. If you're rooting for lower interest rates, and if you're buying a home, you are, inflation is your arch enemy. And you can put yourself in the shoes of a bond investor, and it becomes really easy to see why. If you buy a 30-year mortgage-backed security, you just signed up to receive a fixed payment for up to 30 years. So let's say you're trying to live on the income that you're receiving from your bond. So every month, your payment rolls in, and you've got to pay rent or your mortgage and bills and buy groceries and put gas in the tank and so on. Then inflation kicks in, and it makes everything more expensive. So suddenly this fixed income isn't going as far as it used to. You can't buy as much stuff. You've got to buy less groceries. There's not money left to fill the tank or go on vacation. So to protect yourself from this eroding effect that inflation has on your money and your buying power, you need to charge a higher interest rate. But then when inflation comes back down again, you can be okay with a lower interest rate. Inflation is going to erode your buying power less. So let's put all of this information to work. First, I want to talk about tracking the market to keep tabs on mortgage interest rates. It really feels like we should be keeping a direct eye on those mortgage-backed securities that Fannie Mae issues, and you could do this, but they're really not that easy to track in real time without a paid subscription service. I pay for a couple of these, but you don't have to. Instead, just track the 10-year T-bill. It's easy to track, and it's the bellwether for mortgage rates. Just look at how closely the 30-year fixed rate follows the 10-year T-bill. This chart goes all the way back to 1970, and they track along together beautifully. Notice that the 30-year fixed rate, the turquoise line, is always a little higher than the 10-year T-bill, that red line. And look a little closer, and you may see that the gap between the two varies. Historically, that spread is usually 1.5% to 2%, but occasionally it reaches 3% or even a little bit more. So investors are willing to lend the US government money at a rate that's 1.5% to 2% to maybe 3% lower than they'll lend it to you for a mortgage. So what's that about? Well, it goes back to risk. Government bonds are the lowest risk for all investments. They're often referred to as a zero risk investment. And I suppose if you can print your own money, you're probably not very likely to default on a debt, right? Also, and this is really key for investors considering different bonds for a potential investment, when you buy a 10-year T-bill, you're guaranteed to receive a full 10 years of interest payments from the US government. But buy a mortgage bond and you don't have that guarantee. People can prepay a mortgage anytime they want. Sometimes they move and sell. Sometimes they pay extra to get their loan paid off early. or they refinance. Most mortgages don't last anywhere near 30 years. And as an investor, this isn't really a good thing. Investors are buying bonds because they want to receive interest payments for years to come. So this inherent unpredictability of mortgage bonds makes them a riskier, less predictable, less appealing investment. And, what if interest rates fall and most of the mortgages in the bond you bought refinance? You're going to be left with most of the interest income you paid for not happening, and the value of your bond is likely to fall. So you could really wind up losing money. Now, when it comes to the spread between the 10-year T-bill and the 30-year fixed rate, there is another side note that I should mention. I'm recording this video in early 2023 at a time when rates are still elevated, and a lot of smart money thinks rates will fall in the not too distant future. And if that comes to pass, most of today's borrowers, if you're taking out a loan today, you're probably going to take advantage of those lower rates in the future and refinance to save money. And investors are taking this into consideration, which is part of why the spread between the 10-year and the 30-year mortgage is about as high as it ever gets. When interest rates fall, the risk of prepayment will fall too, and that gap should close a little bit. Now, another obvious takeaway from looking at a long history of the bond market and interest rate activity is that they're always on the move. And zooming in on a chart of bond market activity shows just how much the market can move, even in a single day. Every one of these little bars, which is called a candlestick, represents 1 day of activity in the bond market. The little thin lines are called the wick, and they show the highest and lowest price that bond fetched in a single day. And mortgage rates, and the little fat part, the candle, shows the opening and closing price for the day. So mortgage rates can change at any time with no notice in connection with this activity. Days that the candlesticks are small and stubby, mortgage rates likely stayed the same all day. And what that means is a lender like me will get a rate sheet in the morning for a given loan program, and we can lock in that interest rate for you at the same price all day long. But when you see a big long candlestick, that's a day when there was a lot of volatility in the bond market, and the odds are high that mortgage rates changed during the day, maybe even a few times. Now, as I record this, the bond market is really as volatile as it's ever been. If you exclude the brief moment when the bond market flipped out and lost its mind at the beginning of COVID, and I guess we all kind of flipped out and lost our minds, set that moment in time aside, and 2022 and 2023 kind of stand out. We're kind of right now going through, as I record this, one of the most volatile periods for the bond market and therefore for interest rates. When you're shopping for a home, not knowing what your interest rate is going to be is nerve-wracking, and this volatility is not fun. So wouldn't it be nice if you could just hit pause on the market? Now, obviously, nobody can reach out and literally find a button and hit pause on a huge global financial market, but you can get the same effect by locking in your interest rate. Now, the next thing I'm going to say may sound a little cheeky, but in the most literal sense, there's no such thing as an interest rate lock. A rate lock simply determines who's taking interest rate risk, you or your lender. When your rate isn't locked, which is called floating, all the interest rate risk is yours. The market could go higher or lower, back and forth, and you'll suffer or benefit. But once you lock in an interest rate with your lender, all of that interest rate risk transfers over to your lender. It becomes theirs. And we lenders don't have a magic wand that allows us to freeze the bond market. I wish we did, but we don't, any more than you do. When we lock in your interest rate, and we'll do that when you ask us to, we then need to get your loan through the process and get it closed, and then get it sold on the bond market. And that sale might not happen until 30 days after your loan closes, which could be well after your interest rate lock with your lender expires. And all the while, the bond market is out there trading and interest rates are constantly changing. Now, changing rates are a risk for you. And if rates get worse before you lock, and that's not welcome news, obviously, but you still have a choice. You could decide to suck it up and carry on and live with a higher monthly payment and hope interest rates fall and refinance when they do. Or you could take a pause and wait and sit back and see if interest rates come down before you buy a home or refinance. But for lenders, this market change, all this volatility is really an existential risk. If we promise a few thousand of our clients a 6% interest rate and then rates increase to 7%, we are going to lose our shirts when we sell loans into the market after closing. And if we don't have the money to close, that could actually just put us out of business. We could shut down and wind up bankrupt. And that would be bad for us because we like what we do and we want to keep doing it. But it would be terrible for you too, because you're counting on us to be there and to fund your loan when the time comes that you want to buy your new home. So the good news is we can neutralize interest rate risk both for you and for us. And we do this by hedging. When we lock in your interest rate, we simultaneously buy a financial asset that we know will move in the opposite direction as rates change. So if rates rise after we lock in your rate, we're going to lose money when we sell your loan, but we'll make it back. We'll make back what we lost on the hedge and vice versa. By protecting ourselves from this interest rate risk in this way, we can lock in your rate and let you carry on with your home buying adventure with no worries about interest rates and no worries that we'll be there to deliver on the rate we promised to you. And we can even lock in a rate before you find a home to buy. I can lock in a rate while you're shopping for a home for up to 90 days. And if you're waiting for a new home to be built, I can lock in a rate for up to a year. Providing peace of mind and protection from interest rate volatility is an important service we lenders offer our clients. If you found this information helpful, please like and subscribe. And if you made it this far, maybe you also found your lender. Consider giving me a call. My phone number is in the description below, and I'd love to connect and talk about your plans.